Okay, so I did a video on profitability. I want to do another on liquidity. So liquidity is cash flow. If you're asked to evaluate liquidity, please don't talk about profitability ratios. You're not going to get any credit for it. You need to be talking about what helps to generate cash or could cause issues with the generation of cash within a business. So these areas would be the key ones to look at. So with current ratio, how many current assets we have as a proportion of our current liabilities. So i.e. what have we got which we can turn into cash quickly to pay off those debts which we've got to pay off in the next year. So if current ratio is declining, that means it's less likely we'll be able to pay our debts. And then we have to look at the components of it. So we've got trade receivables, we've got inventory, and we've got cash. Where are the problems? Why are we not able to pay our debts, or are we building up too much of a debt? So we've got to look at factors there. So we maybe we've bought too much stock, we've got too much that we're owing to our trade payables. We've got to think about cash flow. Cash flow is really important because we can't pay our bills, and if we can't pay our bills, we've got a lot of impacts. So if we look a bit deeper and we look at the liquid capital ratio, that deducts inventory. That being a lot lower helps us to identify that we are focusing too much on inventory to pay our debts, and that's a problem because inventory is our least liquid current asset. So therefore, we've got to sell it first. That can take time depending on the nature of the product, and then if we sell on credit, we've got to actually get paid for it. So if you're in an industry where you pay items quickly and you get paid in cash, liquid capital ratio being low is not a problem. But if you're in the opposite, then you've got a major issue. So we're too reliant on inventory to pay debts. If we don't sell our inventory, we've got a problem. Now, obviously, most businesses need to sell to pay their debts, but it's just the idea that too much of our cash is tied up in that area. So what we could also look at then from a liquidity point of view is trade receivable days, because if we are selling on credit, we need to get our items paid for as quickly as we can. So when we're looking at trade receivable days, we're looking at the efficiency of our credit control department to actually get our customers to pay us. If they don't pay us, it's all well and good that we've sold these items and we're generating a profit. If we're not paid, we can't pay all of the items we've already referenced. So when we're looking at trade receivable days, we're looking at, like I said, the credit control department. Could we be more aggressive in our credit control to get people to pay? Problems there because we could upset our customers, they might go elsewhere. Could we offer a cash discount? So could we encourage people to pay quicker by offering them a cash discount? That's great, so they should pay quicker, but will they? They might not see it as that much of an incentive, and equally it's an expense, so therefore that's going to reduce your profitability. But these are all options. We could cut the available credit to our customers, so say they've got to pay quicker. Will we lose them to competitors then? Credit is an incentive for customers to buy from us. And if you've got lots of cash, actually increasing credit could be a good way of encouraging our customers to buy from us. Trade payable days, how quickly we pay our suppliers. Now that's a nuanced one. We want it to be as high as possible because that improves cash flow. So if we're looking from a liquidity point of view, we want to pay our suppliers slowly. And sometimes the question might be, should we pay our suppliers as slowly as possible or delay payments to improve cash flow? That will improve cash flow because we're holding on to our cash for longer. So if we're waiting for inventory to sell, winnings, we can actually get that money in. However, we can upset those suppliers. We might lose out on discounts in the future, or they might just refuse credit full stop. So we're looking at trade payable days. It's increasing, it's good. It's decreasing, it's good because of supplier relationships, but there needs to be a balance. And compare trade payable days to trade receivables. If trade receivables are paying us quicker than we're paying our trade payables, then we're fine. Cash flow is positive. If it's the other way, then we're going to have a problem. So that's an extra bit of work you can do in your response. Inventory turnover, how quickly we sell our stock will determine how quickly we can generate cash. That links to that liquid capital ratio. So if that's low, but inventory turnover is quick, maybe it's not as much of an issue, but it also helps us to appreciate if too much money is tied up in inventory. So obviously, if we've got a lot of inventory, we can't turn that into cash quickly, we've got a massive problem. And then finally, cash flow impact. So you've got to think about, are we relying on overdrafts, the cost of interest? Are we missing out on paying suppliers and the relationship issues or trade discounts we might lose out on? Are we not paying our taxes when they're due? Are we going to lead to legal implications? Are we over trading and therefore run out of cash and therefore cannot continue for the future? Are we not generating a return for our shareholders because we don't have the cash flow to pay them dividends? So liquidity is the bit that closes the business, not profits, because we don't have the money to do all of those things. We've got a major issue. But if you're evaluating liquidity, focus on these areas, not on profitability. Very different thing. Okay, good luck.